We're putting the spotlight now on the independent financial advisory industry with Ian Middleton, MD at Masthead. Thanks so much, Ian, for joining us this afternoon. Well, one would assume that the need for independent financial advisors has increased amidst all the uncertainty and with investors looking for explanations and answers, and that proving to be elusive for the majority right now. Is that the case?
I think it is the case. I think there's a huge amount of information that's out there. There's a huge amount of uncertainty and volatility. People can do it themselves, they can go direct, or they need someone to help make sense of the complexity in the environment that they're faced with. So I think there's absolutely a need for independent personal financial advice.
So the demand for them is out there in South Africa particularly. I mean, we've got the need for financial advice amongst consumers on the one hand to contend with, but on the other, we're faced with the cost of compliance, and that in a scenario of a high unemployment rate. You've got, the South African culture of non-saving becoming a traditional one. So how does that impact the future of the independent financial advisor?
I think it makes it very difficult because I think the advisors on the one hand and the consumers on the other. As you say, we're an undersaved nation. We don't save enough, we don't make enough provision for retirement, and generally we're underinsured. The advisors on the other hand are battling regulation that makes it more difficult at times to deal and provide advice, and also they have an increasing cost base. Government at the same time is looking to try and expand access to financial advice, both the advice side of things as well as product. And
so you're looking in those instances like the proposed National Savings Fund and the Health Fund, for example?
Absolutely. And hand in hand with that goes the cost element. So it's one thing to make it accessible, it's another thing if it's too expensive. Because if it's too expensive, you deny the access. And therefore, as you say, many people at the lower end of the market need that access. But you need to balance the interests of the advisor providing the advice, where that advice has a value and there needs to be a payment for that value, and the person who can afford it. So it's a bit of a dilemma, it's a bit of a catch-22 situation.
How does that, or what kind of playing field does this create within that scenario? And we're looking South Africa specific here.
I think it creates a problematic playing field. I think regulation can go so far in terms of protecting individuals. Our National Treasury's agenda at the moment is increasing access to products. And you can start looking at low-cost products. They did it a couple of years back by introducing Mzansi accounts through the banking system. There's already been some move in the funeral market to provide a low-cost access to products. You have a look at the National Savings Bank and the products through there. So those are mechanisms where they're low-advice products and low-cost products. Problem, though, is people need to be motivated or agitated to go and do something, because they don't wake up in the morning and say, today I need a savings product. They need someone to give them the push and the encouragement to go and do that. And I think there, as an industry, product providers, regulators, media have a role to play to increase the awareness and the need for saving amongst consumers.
So far you've touched on regulatory burdens that are incurred by financial advisors, and how that increases costs that they have to contend with the majority of the South African population not having ventured down this path before, as you say, and these products are basically new territory right now. Many would say the need for regulation warranted. The question is, does regulation in the financial services industry successfully protect consumers?
Partly yes and partly no. I think partly yes. I think we've had protection, and if one looks at protection, the measure of protection is very difficult to determine, because if there are no complaints, maybe the regulation worked. We don't know. If there's no regulation and there are a number of complaints, or there's schemes that end up losing people money, then we say there should have been regulation. I think there's still a way to go, and again, the authorities, Treasury and the Financial Services Board, are on a path to defining the difference between two types of regulation. One will be looked after by the Reserve Bank, and the other by the Financial Services Board, and I think that will help to expand the entire market. At the moment, certain things fall between the cracks, and unfortunately often at the end of that is a consumer who's typically in a needy situation, who ends up losing money, and when they lose money, they lose faith in the system. And if an advisor was part of them losing money, then they lose faith in the advisory system. So we've all got a role to play to be able to push this up.
Let's look at the advisor's role specifically. I mean, when appointing an advisor, what should clients be looking out for? What are the characteristics that actually spell out the role of a typical advisor, specifically in this decade?
I think the first thing is all advisors need to be regulated, and there the Financial Services Board issues licenses to individuals. So pre-2004, you could be approached by anyone claiming to be an advisor, and it was buyer beware. Today they are regulated, but if you start looking at some of the characteristics, I think the first thing is to build a rapport with an advisor. You need to be able to sit down, have a discussion, and get an understanding of what the advisor is going to do, what they expect you to do. Need to know the person, talk through the person's needs, talk through their situations, talk to the affordability of investing, and then be able to plot and plan a way forward. If the advisor doesn't take the time and trouble to get to know the person they're dealing with, what their needs are, what their objectives are, what their time frame is, then I'd say don't deal with that advisor. Often the best advisors come by word of mouth. And it's a case of referrals from someone else you know who's dealt with an advisor. And they come in many forms. Tied advisors, untied advisors, you get best in both. But sometimes you get advisors who unfortunately let the side down.
Absolutely. So those are some of the characteristics that you've got to bear in mind if you're expecting your advisor to add value, one would assume, to your financial well-being at the end of the day.
Absolutely. And you've absolutely got a right to ask your advisor what he or she is going to do, what the conditions are, what the costs are, and you go in there very open-minded.
Well, Ian, thanks so much for joining us at the desk this afternoon. Of course, Ian Middleton, MD of Masthead, joining us at the desk and just unpacking the role of the financial advisor in what is and has become a very complex minefield to navigate.